Picture this, a skyline that once hummed with energy now feels like a set left over from a film. Elevators that used to groan with morning commuters sit idle. Cafes that depended on office foot traffic board their windows. This is not a dystopian fantasy. This is commercial real estate in 2025. A silent collapse playing out across global cities, and the consequences are enormous. Today, we climb the first 5 levels of a 10-part descent that explains how a structural shift in work, consumption, finance, and policy turned one of the world's most stable asset classes into a trillion-dollar time bomb. These aren't isolated anecdotes. They're connected failures: human behavior, corporate strategy, banking balance sheets, and broken incentives, all colliding at once. Level 1. The remote work revolution. What began as a pandemic-era experiment became a durable rewire of corporate life. Remote and hybrid work didn't crush productivity the way some warned. For many companies, it produced equal or even higher output, and employees valued flexibility. The result? Firms realized they could pay less for office space and still get similar results. Demand for office space is projected to fall materially in major cities. Studies show declines in demand of double-digit percentages in places like San Francisco and New York relative to pre-pandemic baselines. CEOs saw payroll as less tied to a downtown footprint and started downsizing real estate footprints by tens of percent. Tech giants and professional firms scaled back leases or delayed renewals. When the largest tenants shrink, vacancy cascades. And when vacancy rises, landlords cut rents, then cut maintenance, and the spiral begins. This one behavioral shift, people working from kitchen tables instead of corner offices, is the trigger for everything that follows. Level 2. Ghost towers in global cities. Cities built around office ecosystems now stare at vast swaths of empty floor plate. Office vacancy in the US hit record highs, with national vacancy rates moving into the high teens. And in secondary markets, the effect is often worse. In major financial centers, long-standing availability metrics spiked, leaving entire districts hollowed out. In practical terms, that means less foot traffic for restaurants, fewer commuters on transit lines, and declining revenue for urban retail and services. Those empty towers aren't inert, they're economic levers. A single vacancy wave depresses nearby retail rents, reduces garage revenues, collapses demand for daycare slots, and even affects taxi and rideshare volumes. The city's economic logic, built for concentrated daily human flow, now creaks. Level 3 are EITs in crisis. Commercial real estate isn't only physical, it's financialized. REITs, real estate investment trusts, turned office buildings and malls into tradable assets on pension funds and retirement accounts balance sheets. When cash flows decline, REITs lose valuations fast. Several large commercial REITs saw sharp drawdowns and dividend cuts, which reverberated into retirement funds and income-focused portfolios. Headlines about slashed payouts aren't trivia. They're retirees losing monthly income and long-term savers seeing portfolio safe income assumptions evaporate. The investment model that treated office rent as a reliable annuity is broken when the customer base vanishes. Institutional investors that expected steady yields now face volatility and the prospect of writing down billions in asset value. Level 4. Banks' hidden real estate risk. Here's where the story gets systemic. Banks, especially regional and community banks, hold enormous piles of commercial real estate loans. These loans were underwritten in a different era of low rates and stable leasing markets. Now, with higher rates, falling NOI, net operating income, and loan maturities approaching, the math looks dangerous. Federal reviews and watchdog reports repeatedly flag CRE concentration as a top risk for smaller banks. The balance sheet vulnerability is not theoretical. When loan collateral, the buildings, loses value, the bank's capital cushions shrink. And that can trigger lending freezes, fire sale asset dumps, or even failures. Analysts show that some mid-sized banks have CRE portfolios that are a very high share of assets. In certain institutions, it can be 40% or more, creating the kind of exposure that cascades from one local market to national contagion. Level 5. Foreclosures on skyscrapers. This is the image that shocks people. Empty trophy towers returned to lenders. Foreclosure on a single marquee building is more than a local story. It becomes a pricing anchor that drags down values across an entire CBD, Central Business District. Lenders suddenly holding complex, illiquid real estate face two bad choices: manage and operate a building they never wanted, or sell at steep discounts that inflict losses on investors and sponsors. We're already seeing distressed sales, loan workouts, and properties moved to special servicers, the quiet prelude to a larger rise in formal foreclosure events if market dysfunction accelerates. Level 6. Cities losing their tax base. Commercial property isn't just private wealth, it's municipal revenue, property taxes, business taxes, sales taxes from office workers. Together they fund police, fire, transit, schools, and street repairs. When tax rolls shrink, cities can't cover basic services. The math is brutal. In many downtowns, a single large office tower contributed millions annually in taxes and economic spillovers. When that tower sits empty or is sold at a fire sale price, the tax assessor's valuation follows, and city budgets fall with it. Municipalities face three painful choices: raise taxes, cut services, or borrow. All three accelerate decline. Fewer services make cities less attractive. Less attractiveness drives more departures. Departures further erode the tax base. It becomes a vicious spiral. Level 7. Zombie malls and suburban rot. If urban cores hollow out, suburbs rot in their own way. Malls and shopping centers, once community hubs, are becoming zombie malls, partially occupied shells that drain local economies. The drivers are clear: e-commerce, changing consumer habits, and loss of commuter/office foot traffic combine to make many retail centers economically unviable. The social cost is heavy. Malls supported thousands of local jobs and created incidental commerce for nearby neighborhoods. When they die, small businesses dependent on mall traffic vanish. Parking lots decay, and local tax receipts fall. In some countries, analysts documented entire cohorts of small malls shifting above 40% vacancy and being labeled ghost malls. That's not just a retail cycle. It's community collapse playing out in slow motion. Level 8. Urban repurposing wars. Convert the office to apartments is the pundits' mantra. But reality is messier, costlier, and politically explosive. Office to residential conversions face severe technical hurdles. Floor plates designed for dense, internal cubicles make natural light and window access scarce. Mechanical systems, HVAC, plumbing, fire suppression, need wholesale upgrades. Elevator cores and egress paths may be incompatible. Add zoning, labor costs, and building code rewrites. Conversions can easily eat hundreds of dollars per square foot. Some recent projects have reported conversion costs in the low hundreds per square foot. In high-cost cities, the tab can be far higher, making many projects uneconomic. Level 9. Commercial RE Armageddon. Here's the nightmare scenario. Too many distressed properties hit the market at once, and buyers vanish. The usual reset mechanism for market corrections, buyers stepping in to buy discounted assets, is paralyzed when capital providers are themselves under stress or when lenders fear further downside. That creates a market stalemate. Sellers can't transact, and holders can't mark to market without realizing catastrophic losses. We're already seeing early indicators. Special servicing rates on commercial mortgage-backed securities, CMBS, rose sharply, signaling more loans in trouble and more assets being transferred to workout specialists. Level 10. The Great Reset of Land Use. The final level is not just a crisis, it's transformation. Whether by design or necessity, we will re-architect how cities work. This could be the most important urban policy shift of our lifetimes. Expect radical outcomes: downtowns rezoned for mixed uses, tax incentives to attract residential conversions, public-private deals to turn dead retail into logistics hubs, urban farms, data centers, micro-factories, or civic space. Some cities will subsidize conversions, others will nationalize derelict properties for public purposes. Transportation systems that were built to shuttle workers to central business districts may be repurposed for neighborhood connectivity. Financial models for municipal finance will be reimagined, moving away from reliance on commercial property taxes toward more diversified revenue streams. That said, the reset is uneven. Affluent cities with diversified economies and low vacancy will adapt faster. Single-industry towns or those dependent on a handful of large office tenants may face prolonged decline. The social consequences, displacement, unequal recovery, and political backlash will be deep. If this hit you, subscribe to Econ Fix Explained. We'll keep dissecting this crisis, map the opportunities, and show how to protect your money and your city in the Great Reset.